Let's be real, the fastest way to attract buyers to a net lease deal. Put Chick-fil-A, McDonald's or Taco Bell on the sign. Quick service restaurants or QSRs are the undisputed kings of the NNN market. But what makes these fast food properties so attractive? And what do you need to watch out for before investing? Let's break it down. So why are QSRs always red hot? First, the demand. Everyone eats. Even in recessions, QSRs thrive. They offer affordable meals. They pivoted fast during COVID with drive-thru and mobile pickup. They've got national brand recognition and daily foot traffic. Next, the lease structure. 15 to 20-year initial term. Rental bumps every 5 years. Absolute NNN terms with no landlord responsibilities. Plus, most are located on hard corners, high-traffic corridors, prime real estate that holds value even if the tenant leaves. Franchise versus corporate? It matters. Not every McDonald's lease is backed by McDonald's Corp. You might be leasing to a 5-unit franchisee, a multi-brand operator. A single location LLC franchise leases often offer higher cap rates, more flexibility, greater risk, corporate leases, lower yields, stronger credit, tighter control over terms. Always read the guarantee clause and check financials. The logo isn't the lease. Drive-thru often equals premium value. Today's investors pay a premium for QSRs with dual drive-thru lanes, dedicated pickup windows, mobile order infrastructure. Why? Because drive-thru accounts for 65 to 70% plus of total sales at many QSRs. If the location has no drive-thru, you're taking a risk, especially with newer post-pandemic consumer behavior. What to watch for in the lease? 1. Use clauses. Does the tenant have the right to change brands? Is it specific to QSR only? 2. Assignment clauses. Can they sell the location to another franchisee? Are you protected from weak operators taking over? 3. Parking and access. If cross easements are involved, review them. Limited parking equals capped revenue. QAT. Rent escalations. Flat rent. You lose to inflation. Push for 10% every 5 years or 1.5 to 2% annually. What are some common pitfalls? Assuming all franchisees are financially strong. Ignoring co-tenancy if the QSR is part of a larger center. Overpaying for low credit operators due to a strong brand sign. What makes a QSR site bulletproof? National brand with solid corporate or franchise backing. Prime hard corner real estate. Strong drive-thru infrastructure. High AUV. Average unit volume. History. Solid rent escalations with no landlord obligations who's buying QSRs. That's why it is such a large investment class. It simply has such a massive potential to attract all kinds of investors. You can encounter the $400,000 Waffle House deal for the small investor or the $100 million sale-leaseback portfolio that might get acquired by the institutional REIT. You can have high-risk and high-yield opportunities offered by a single-unit entity or operator. Alternatively, you have publicly traded credit-grade tenants providing the perception of immense stability in exchange for tighter returns. So, who are the buyers in general? 1031. Exchange buyers. Private wealth looking for mailbox money. Family offices seeking passive inflation, hedged income. That's just to name a few. And because these assets are digestible, usually 4,000 miles, there's always a new buyer coming in behind you. To wrap up, QSRs dominate the NN market because they offer stability, visibility, predictability. But don't get caught in the hype. Underwrite the tenant, the lease, the dirt, and the upside. And if you want a full QSR lease audit checklist, follow our Instagram. Subscribe for smarter CRE investing. And I'll see you next time.